Listen up, investors. Tip number 3. Understand if a stock is either a growth investment or a value investment. Before you throw your hard-earned money into the market, you gotta know what you're getting into. Just like you wouldn't buy a car without knowing if it's a sports car or a minivan, you shouldn't buy a stock without understanding its investment style. Knowing the difference between growth and value investing is crucial for success. It's about matching your investment strategy to your risk tolerance and financial goals. Think of it like this. Are you the kind of person who likes to play it safe and steady, or do you prefer to swing for the fences and aim for those big gains? Your answer will determine whether you lean towards value investing or growth investing. Understanding these two fundamental approaches will help you make smarter decisions and build a portfolio that aligns with your investment personality. Remember, knowledge is power in the stock market. The more you understand about different investment types, the better equipped you'll be to navigate the ups and downs and come out ahead. So, buckle up, because we're about to dive into the exciting world of growth and value investing. Let's talk value investing, folks. This strategy is all about finding those hidden gems, those undervalued companies that the market has overlooked. Think of it like treasure hunting for stocks. Value investors are like detectives, searching for clues in financial statements and market trends. They're looking for companies with strong fundamentals, solid earnings, and a history of paying dividends. One of the most famous value investors of all time is Warren Buffett. He's a master at finding those diamonds in the rough. He looks for companies with a wide moat, a competitive advantage that protects their profits. Value investors are patient. They're in it for the long haul. They believe that the market will eventually recognize the true worth of these undervalued companies, leading to stock price appreciation. Now let's talk about growth investing. This strategy is for those who aren't afraid of a little risk and want to ride the wave of innovation. Growth investors are looking for companies with the potential to grow at above-average rates. They're not as concerned with current earnings or dividends, they're focused on future potential. Think tech companies, biotech firms, or any company with a disruptive product or service. Companies like eBay and PayPal in their early days were classic growth stocks. They were revolutionizing the way we shop and pay online. Growth investors are willing to pay a premium for these companies because they believe the future growth potential justifies the higher price. However, growth investing is not without its risks. These companies often have high valuations, and if they fail to meet their growth targets, their stock prices can plummet. It's a high-risk, high-reward approach. From growth to value. A tricky transition. Here's where things get interesting. Sometimes a company that starts as a high-flying growth stock will mature and transition into a value stock. This transition can be tricky and often catches investors off guard. As a company matures, its growth rate naturally slows down. It's no longer the hot new thing on the block. This can be a difficult adjustment for investors who bought the stock during its growth phase. They may be reluctant to sell, hoping the company will regain its former glory. However, holding on to a stock that's no longer a good fit for your investment strategy can be costly. It's important to remember that a company's investment profile can change over time. What was once a growth stock may now be a value stock, or vice versa. It's crucial to reassess your holdings regularly to ensure they still align with your investment goals. So, stuck in between the case of eBay and PayPal. Let's look at a real-world example, eBay and PayPal. These two companies were once synonymous with growth. They were at the forefront of the e-commerce revolution. However, as the market matured and competition intensified, their growth rates slowed. They were no longer the disruptors, they were the incumbents. This left eBay and PayPal in a sort of no man's land. They weren't growing fast enough to be considered growth stocks, but they weren't cheap enough to be considered value stocks either. This uncertainty can make it difficult for investors to know how to value these companies and whether they belong in a growth or value portfolio. This example highlights the importance of understanding the difference between growth and value investing. It's not always clear-cut, and some companies may straddle the line. As an investor, it's your job to do your homework and determine which category a stock falls into so you can make informed investment decisions. So guys, growth or value, the bottom line. So there you have it. Growth and value investing are two distinct approaches to navigating the stock market. Growth investing is like riding a rocket ship. It's exciting, potentially lucrative, but also risky. Value investing is more like treasure hunting. It requires patience, research, and a keen eye for finding undervalued assets. The key takeaway is this: there's no right or wrong answer when it comes to choosing between growth and value investing. The best approach for you depends on your individual risk tolerance, investment timeline, and financial goals. The most important thing is to understand the difference between these two investment styles and choose the one that aligns best with your overall investment strategy. Remember to diversify your portfolio and always do your research.